Welcome to TheoTrade. This is Don Kaufman. In this video, we're going to be talking a bit about trading options in and around expiration. And if you're not aware, really, any week can be considered an expiration week. So what we're looking at here is a December of 2015 expiration. I've got 2 days left until the expiration. So what am I looking at here? We sit on a Thursday. Tomorrow, these options are toast. They're gone. But we're also going to look at, hey, the fact of the matter is every week is an expiration when you've got weeklies. So more often than not, if you trade options, you're trading in and around expiration. So what I'm going to show you is a little bit about the good, the bad, the ugly of ultimately carrying positions to expiration. Now, some of you are going to initiate positions right before expiration. Hopefully, this video is just going to get you through some of the pitfalls of and really the risks of doing just that. So let's kind of get into it here. One of the first things you want to do is if you're trading options around expiration, you got to get an understanding of how the options are going to move differently from, for instance, the 2-day expiration to the 7-day expiration. So what I'm going to do is change this open interest column over to options, theoreticals, and Greeks. One of my information layouts, I'm going to make delta. Okay, so why delta? So if we take a look at the standard definition of delta, and there's literally a half a dozen definitions for delta, but the standardized definition for delta, it's the rate of change of the option for every dollar increment move in the stock. So what it means is this option that's currently trading about 56 cents, all right, so 56 cents, it's going to be moving, okay, at about 42 cents for every $1 move in the spiders. Now, I like to use the spiders, like the marquee ETF over here. So this option, I mean, that's pretty crazy when you think about it. It's a 50 some odd cent option that's going to be moving at what? 44 cents for a $1 move. Like, ooh, yeah, that's some good stuff. I mean, that's some action in there. And then, of course, you go out to the 7-day option. And again, it's important to recognize how things are going to change from one expiration to the other. So with 2 days left, all right, this option is just, wild in terms of volatility because, you take the 60-cent option that's all of a sudden be worth what? Nothing, or it's going to be worth double versus when you look out 7 days from expiration, here's an option trading for $1.30 that's being affected by about 47 cents. So how much the delta from one expiration to the other, that doesn't differ too vastly for at-the-money options, but on a percentage basis, okay, it varies widely. So the next information column that you really want to open up over here under options, theoreticals, and Greeks, what really drives options around expiration is none other than gamma. So again, to go into and explain a lot of the Greeks over here, I mean, I could take hours, literally hours, to explain to you everything about the Greeks. And a lot of people, they just kind of circumnavigate the Greeks. I don't need no stinking Greeks. But you have to have a little bit of an understanding of the Greeks to make this work for you in and around the expiration cycle. This is one of the biggest differentials, is that gamma, okay, is ultimately exploding in and around the expiration cycle, where the gamma 7 days out is doing next to nothing. So what is gamma? So gamma, okay, is really the rate of change of this delta. What that ultimately means, okay, is if you look at delta as, let's say it's the speed to which this option is moving, all right? So, I mean, listen, this thing's almost 50 cents here, right? That's almost 50 cents, and the option's not trading much more than 50 cents. So you're like, oh, wow, that's crazy. But you look at gamma as the acceleration, okay, of this delta. And that basically means for the first dollar move, the option's going to be impacted by about what? By about 48 cents. For the second dollar move, it's going to be 48 cents plus or minus whatever the gamma is. So 48 cents plus, 23 cents. All of a sudden, you're talking about what? Like a 70-cent kind of move over here. Or you can just, cheat and do it this way. All you have to do to figure out movement is what? This is a 207.5. look, $1 in the money, your new delta would be 71 cents. If the option fell, okay, or the stock, I should say, fell by about $1, you have this 207, that'd be worth what? The same thing as the 208s. The option would drop down to about, 26, 27 cents in this particular case. So that's the cheating person's way of figuring out like the new delta and what your risk is ultimately going to be. There's actually a name for that. It's the strike price shift increment. What that ultimately means is if you want to know what this option is going to be worth, and this is the 207, okay, calls. If you want to know what it's going to be worth, right now, if there's a $1 move in the spiders, just look $1 in the money or $1 out of the money. All right, so let's clean up the option chain here really quick and take another look at that. Because what it's saying is this option right now, okay, is worth some, 57 cents. If we move up $1 right now, it's going to be worth right in this neighborhood. If we move down $1 right now, it's going to be worth in this neighborhood. And that's the fastest way to assess it without ever using delta, without ever using gamma. But back to our discussion on gamma, I just want you to see how explosive the gamma is. The reason I say that is there's this kind of a misnomer in options trading. Everybody's like, oh man, you should go out and you should sell options right before expiration. I mean, come on. Only 2 days to sweat. Most experienced traders, and this is kind of a big irony because it's totally misunderstood, but most big traders and experienced traders, people I've worked, with in the industry for years and years and years, they're actually more likely to be buyers of options right before expiration. Okay. And the reason they're likely to be buyers of options before expiration is they're taking shots or bets. So they'll go out and say like, hey, you know what? What the heck? I'll risk, 26 cents for the chance that the stock moves up like $1 or $2. And all of a sudden I go from, 26 cents and double it, with $1 move. And that's a likely scenario. Most experienced traders are closing positions when they've sold options. Most experienced traders are closing positions prior to the expiration to mitigate or control the gamma risk. And what that gamma risk really is, and if you've ever heard that term like negative gamma, that's really what I'm talking about here. What that negative gamma risk really entails is the options themselves. The best way to put it is they become erratic closer to expiration, completely and totally erratic. And when they're erratic, it's like, watch out! You don't know what I'm going to do. And that's exactly why traders close them before expiration. Because the more they're erratic that they are, you can't hedge the position. It just, when I say hedge it, if I'm short, okay, if I'm short, let's say a 10 lot of these 207.5 calls, how am I going to reduce my risk on that? Okay, I'm basically left to the devices of the market. If the market right now, which is down $1.20 today, what happens if it exploded to the upside and I'm short these 207.5 calls? You're like, well, you could cover them. Okay, no, the market's moving around quickly. You don't have time to cover it. And most, again, experienced traders are going to realize that if the market moved up $1, these options are going to go from 48 cents. They're going to be worth $1. Right? They're going to go from, now it's almost 50 cents right to $1. You're going to get 100% move against you in an instant. And that's where I step back and I go, why the heck would I want to risk, okay, that kind of capital? It doesn't make sense. It doesn't make sense to sell an option and only have 43 cents left and all of a sudden lose 100% or even greater in an instant if the market rallies. And that is the understanding that most experienced traders have. So if you've sold options, okay, yes, options do decay substantially right before the expiration cycle. Like everybody's seen the decay graph. It's like, boom, falls off the cliff. And, that good portion of decay is that last 3 days. You know what the irony of that is? The best amounts of decay bring upon the greatest amounts of risk. There's this trade-off that you take. If you want like heavy decay, you got to take amazing amounts of negative gamma risk. So when I say the good, the bad, and the ugly, I'm actually, promoting in here, close your short options even in a spread scenario, close your short option positions, okay, a few days before the expiration. And if you're just trading like covered calls, sure, covered calls, but those trades are covered, right? You got the stock and you're short the option, sure, you can carry those to Thursday or Friday of expiration week because you're covered on it. But if you're just out there selling options, whether naked or in spreads, you should seriously consider closing the position and rolling it a few days before the expiration. Okay, ideally, you want to think of if you're trading for like, some option spreads, got like 6 weeks on, you want to close that thing 3, 4, maybe even 5 trading days before the expiration cycle. Because when you start coming into Wednesday or Thursday of expiration week, it's starting to get serious at that point. Like, look how fast these option prices have changed. You just saw the market was down, what? It was down $1.20. That was only about, less than a minute ago. It's rallied 20 cents. And 20 cents, the option over here went from where? Okay, from nothing to something. Okay, we were looking a moment ago at these 207.5s. Okay, their delta was all the way up to like a 47 delta. Now it's like a 39 delta. Again, options right before expiration, the best way to think of them, schizophrenic. All right, they're all over the place. And when the options are schizophrenic like that, it makes it next to impossible to manage your risk when you're short those options. So think about that when you're, considering trading these options in and around or even at the expiration cycle. Now, where is there, a good portion in this discussion? The good portion is if you want to trade options, even on an intraday basis, you can get almost a 1-for-1 movement. That is the options to the stock, almost a 1-for-1 movement if you just go a few strikes in the money. So in this case, I'm going to go ahead. I'm going to open up about 12 strikes, and you're getting like, 90 delta options over here. What that basically means is this is a great stock substitute, but you got to get in and out of it very, very quickly. And these weeklies, every week, you have the advantages of being able to do just this, to use these high delta options as, if you will, stock substitutes. And the nice thing is, if you buy the calls, that substitutes what? Long stock position. If you buy the in the money, again, puts, what does that do? Short stock substitute. So think about using this because then it limits your risk to roughly what? $3. All right, that's it. If the market crashes, $3 a risk. Think about, again, what you're doing prior to expiration because many, many mistakes are made in and around trading options coming into the expiration because all a lot of people think about is just, 2 more days, 40 cents. They don't think about the fact that you could lose 200% given the fact that the markets can gap overnight. So keep your head up around expiration, close a lot of positions, clean up your risk, and be much better for it. Thanks a lot, everybody, for joining us here at TheoTrade.